Welcome back to Wake Up with Cheddar. So for more on the markets, I do want to bring in our next guest, David Waddell, CEO and Chief Investment Strategist at Waddell & Associates. David, it's great to see you this morning. So the major stock market indices continue to rise as this Reddit trade seems to unwind a bit. Many of these stocks pointing to losses this morning, adding to losses that we saw yesterday. Explain what's going on in this market from your purview.
Well, we got a little bit distracted from the news by the chat last week. And the chat was, of course, GameStop and what's happened inside that Reddit chat room. And that was very interesting, led to some liquidations. But the news, and y'all just talked about this, is how good the earnings season really is. So 82% of companies that have reported have beaten estimates. The number that are raising their guidance is twice the average. I mean, earnings are just crushing expectations right now, and that'll roll into next year. So you've got economic data that's been solid, estimates rising on that front. You've got, again, Congress and the president seeming to have somewhat composed meetings about stimulus, which could add even more lift to the economy. So you've got rising economic estimates, rising earnings estimates, which is going to lead to rising stock prices. We just got a little bit distracted by the GameStop last week.
So I do want to focus, though, on the retail trading craze. We've had guests come on this show on other networks that have said, look, more retail participation holistically is better. The more volumes that we can see, the more liquidity that we can see, that is better for the market long term. Do you agree with that?
I do, and I also think it's indicative of a broader issue, which is there is so much money sloshing around. I mean, M2, which is the money supply figure most people look at, is up 30% year over year. Savings rates are at 14.5%. They were negative prior to the financial crisis, for instance. So there's a lot of money sitting around, and there are no sporting events, and there are no concerts to go to. And the stock market's pretty exciting. I mean, I've built a career around it, and I'm not bored ever. So the retail trading thing is something that is a sign of the times, and it goes back to all the money that washes around. And so if you have 8 million people in that chat room as of this morning, and they got $10,000 a piece, that's $80 billion worth of buying power. I think the market cap of GameStop is 15 billion right now. I mean, they can move stuff around. Cryptocurrency is $1 trillion. They can move stuff around there. They're trying to attack silver. I don't think they have enough to do that. So it just goes back to there's a lot of money, there's a lot of idle time, and it pushes markets around.
Certainly, we know there's tons of money on the sidelines. I mean, more than $1 trillion. David, I know you follow those numbers as well, but it's interesting. GameStop down 34% pre-market, lost 31% yesterday. Even silver cooling down today after we did see it rise yesterday. So it does appear as if, at least for the time being, there is a bit of a pause. Of course, it coincides with Robinhood and other brokerages putting limitations on trading, perhaps in some ways turning off the retail investor. We have to wait to see how all of that unfolds, but it doesn't mean that there aren't heavily shorted stocks that still exist in this market. And so even though we see a pause at this very moment, what's to stop retail traders or others from going after some of these other heavily shorted stocks that haven't been targets just yet? And what's the impact to the broad market?
Well, I don't run a hedge fund, but if I did, I would have been paying attention last week, and I would have changed my positions, or at least, bought some insurance policies against them. So it's not going to be as easy round 2 and round 3. I think what likely happens is that group ends up in a zero-sum game where they find a stock that's lightly traded and then they jump in. And if you're first in and first out, you make money. If you're last in and last out, you lose money. And so it becomes kind of a zero-sum game within that crowd, because the nice thing about GameStop, and it was sort of the perfect stock to do it in, they had a common enemy they could attack, and that enemy was vulnerable. I don't think the enemies are going to be as vulnerable going forward, which means they'll start attacking each other. So I'm not sure that that's really a game that people want to play. It's zero sum. So we'll see how it plays out, but I'm ecstatic that they're in the market. And by the way, I was in chat rooms in 1998, 1999. I mean, this isn't necessarily new. It's just astounding at the speed and the ubiquity of what's happening. So I've seen the game before, and it's come and gone.
So I think that you bring up a really good point there, that if you're a hedge fund, last week you were looking at long term, how do you basically put some insurance in place to make sure that this doesn't happen to you again, so you don't go the way of Melvin Capital, which was down worse than 50% in January and had to get a bailout to the tune of $3 billion from some of its peers. Andrew Left, also a famed short seller for years, and some would say that he was a positive overall in the market, highlighting some inefficiencies in companies that weren't necessarily always run as properly as they should be holistically. But I do think that your point there is noted, that it might not be as easy to see this a second time around. So what advice would you give to a retail trader? I mean, what's a wise way to look at the money that they do have on the sidelines and put it to work positively, maybe less risky in this market?
Well, I mean, having gone through the bubble in 2000, people became sort of fundamentalists, right? So suddenly the technical game was over and they had to start doing some homework and figure out where the real values were and then extend their time horizons. And the day trader thing, it sparks up every once in a while, but it's a really hard game to play. Otherwise, the big institutions would be day traders, and they're not. They're intermediate term traders, unless they're high frequency traders or some sort of, tech fueled system. So I think it's a great training mechanism, because everybody learned how to buy GameStop last week, but this week they have to learn how to sell. And the people that sold, obviously the stock's cascading lower. Those paper profits are paper profits until you take them. So they're learning these lessons as they go. I think the other big lesson in this is you got to think real hard about who your counterparty is. I remember back during the financial crisis that the one thing I didn't worry about with my clients was Charles Schwab and Fidelity, where we parked our assets, weren't going out of business because they didn't have investment banks. So the lesson with Robinhood, and they've had to raise a ton of capital, is they weren't really well capitalized enough to handle all this trading volume. So you have to learn how to sell. You also have to think about who your counterparty is in terms of your trading partner. I mean, there are a lot of good lessons in here, and those that pay attention and learn those lessons are going to be better positioned to make money over the long term. So this is just a training mechanism.
We are going to see hearings, investigations into what exactly happened last week. Was Robinhood truly fair in its process of implementing these limitations? But David, quickly before I have to let you go, where do you see opportunity in this market?
I see opportunity in places that have been unloved. Like I said, it's all about money flow. The money flow has been in the big FANG stocks for a long time. Now it's looking for other homes. The money flow into small cap stocks over the last 2 weeks or so has been historic. The money flow into emerging markets has started up again after 10 years of not really being in play. And so there are plenty of places in this market to go. Just go back and review 2000 to 2006 and pick the stuff that worked then. We're just reprising that whole scenario.
All right, David Waddell, CEO and Chief Investment Strategist at Waddell & Associates. Thank you.